Hello, NAAIA community. Get ready to relive insightful discussions, gain fresh perspectives, and be inspired by the wealth of knowledge our community has to offer. Let's dive into another episode.
Hello, everyone. I am so excited to be here to be discussing this topic with you all. And I promise you, we've got some pretty heavy hitters, I think, coming to join us who bring a variety of experience to this topic regarding class code switching. So we're going to start with one of our first panelists, Ryan Johnson. Ryan Johnson is the underwriting team leader at CRC. Ryan, if you could come join us to the stage.
Hi, Tabitha. Thank you. Bye.
You want to tell us a little bit about yourself real quick, Ryan, your background, so that we can just give a quick hello?
Hi, everybody. Yeah, my name is Ryan Johnson. I'm underwriting team lead with CRC, as she said. Background is I've had a 100% commercial background, worked for the MGA side majority of my career. I've been in the industry for about 12 years now. And I also have been on the carrier side as well. So I spent time working for a company called Hiscox. And so, yeah, I'm excited to be here.
Okay, so next we have LaSeante Thurman, who's the business development underwriter at ICW. Come on, Ms. Thurman, to the stage. We're looking forward to having you here. Join us.
Hello, everyone. My name is LaSeante Thurman. Great to be here. I appreciate the invitation to speak with all of you. As you heard, my name is LaSeante Thurman. I am a business development underwriter for ICW Group. I have about 16 and a half years of industry experience, both on the claim side and underwriting side. Handle auto, property, and inland marine claims, as well as middle market technology underwriting, small business commercial underwriting, property E&S, and I currently work for monoline workers' comp. So I am excited to have the discussion with you today.
All right. And last but certainly not least, Mr. Deon Hornsby, the underwriting director at Private Client Select. Deon, come and join us here on stage.
Good morning, everybody. My name is Deon Hornsby. I'm the underwriting director for Private Client Select, which is a high net worth MGU. I have over 27 years of experience in the industry, all of which in personal lines, starting out as an underwriter in the Southern Auto Division in Illinois with State Farm Insurance, transitioning all the way through to my role now, which is I've been in this role for 2 years. But I've been in a high net worth personal line space since the year 2000. So looking forward to this conversation.
All right. So look, as I told you all, some heavy hitters with a wide variety of experience to help us with this topic today. So we're going to get kicked off and going because I know that you all are excited as I am to talk about this discussion of class code switching. And I know that myself and the panelists were all very excited to kind of dig in. So we have some questions that we're going to kind of start off with, but I'm hoping that you all will engage with us, drop questions in the Q&A. I will be monitoring those questions as well and folding them into our discussion. We will do our best to get to as much as we can. So please, again, just as a reminder, if you want these panelists to answer your questions, drop them for us here in the Q&A. So with all of that, let's get started. I would say that we all either know someone personally, we work with a client, or we've had a risk that's come across our desk that's involved multiple class codes, multiple business operations or services. And in this economic environment, we see people kind of branching out more, expanding their entrepreneurial reach, right? So we're going to look at some of the insurance implications for those individuals and for those businesses, quite frankly. So to kick us off, the first question that I've got is, when a professional offers multiple unrelated services. So maybe they're doing tax preparation, they've got auto repair, maybe they've got a babysitting service on their side. Can a single policy be written? Ryan, what say you?
So yes, they can actually have different exposures. Listed on their policy depending on the setup of their entity or themselves. So if Tabitha Richardson decides she wants to do auto repair with babysitting with tattooing, yeah, they can be covered. It's really a matter of how much you're performing in each industry or each classification. And then the carriers will rate based on the essentially carriers have their different kind of aspects, but they will rate on the highest exposure to get the most premium back.
Okay.
Yes.
So now I heard you say something about names, and I kind of want to dig into that a little bit more. So does it make a difference if it's me, Tabitha, or it's Deon LLC? Does that make a difference how I can set that up as one policy or not?
Yes, absolutely. So there does have to be common ownership with Tabitha Richardson and Deon Hornsby LLC in order to establish a one policy rule. If you do have separate operations that you are performing as just Tabitha, then I would say you need to separate that with the actual LLC entity or the corporation or the S corp or however the other entity is set up. But as a sole person, if you don't have any entity set up, then you would have to establish it all in your name.
Okay. So now, Deon, I'm going to throw this to you. But I have homeowners policy that has my name on it, right? So doesn't that policy give me coverage for my babysitting services or my auto repair that I'm doing in the driveway?
Well, to a certain extent, from a liability standpoint, your name, you being the named insured, you are provided a certain amount of liability coverage, but the homeowner's policy is strictly a personal homeowner's policy. It's not necessarily accounting for the business that you may be running. So if the underwriter isn't aware of what other entities or activities are that are taking place at the home, that could change the calculus in the situation of a claim, right? Because once we find out the details of the claim, if we find out other things are going on at the home, that's going to cause further investigation. And I'm not here to say whether or not there's coverage or not, but there could be more questions asked about what the coverage is, and not only from that claim situation, your renewability, right? Is your home the way that you initially presented to the underwriter, so that they could properly rate and make their underwriting decision? If the risk is something different than what they initially agreed to, then there could be some coverage questions down the line.
So I think what I heard you say is my home could contemplate my business operations if I properly disclosed it up front to the underwriter.
Correct.
Okay.
It's all about the communication with the underwriter. We talk about all the time, know the client and know the exposure. So all these questions need to be asked. So for a lot of the agents out there, the underwriters aren't being jerks by asking all of these questions. We're trying to get as full understanding of the risk and the exposure as possible so that we can make the proper underwriting decision.
Okay. So, I want to fold in LaSeante into this conversation because, I'm running this auto repair service and the babysitting service. And of course, I have some employees and somebody gets hurt. What's happening with my workers' compensation there when I'm mixing all of these different services in one place?
So as Ryan mentioned, it's going to be about combinability. That's going to be a huge factor as to whether or not all of the entities are combinable, because it does have to be common ownership, right? Additionally, you have to classify it correctly because there are going to be multiple class codes that would have to go on the policy. And then making sure that that payroll is segregated per class code. So that's going to be important because what you want to do is make sure that you have the proper payroll with the class code. Otherwise, you run the risk of all the payroll being put into the highest class code, which is going to cost more money for the client. And then also, you want to make sure that the roles are definitively defined, right? Because you don't want any employee role crossover. So if you're going to put all of your employees in 8810, make sure they're not out there doing outside sales. So that's gonna come into play later on when come audit time, of course, right? You want to make sure that there's no crossover there and that is, very distinct in who's doing what role for the company or whichever entity that they're being employed for.
So are we looking for a similar classification in our workers' compensation policy that we have maybe in the general liability policy? Are those supposed to be the same or should they be different?
There should be some alignment. Usually there's, like based on the classification that you have there. But there is an overlap with, like you said, for the auto repair, there's going to be a specific code in the GL class code that's different from the workers' comp class code. But they align in the sense that the rate is pretty much the same. You know what I mean? As far as how they're going to treat each individual or each policy separately. So I would say, yes, there is alignment. The class codes will differ because it's a different product. GL is a different product than workers' comp, but there should be some alignment there. Maybe not with regard to the clerical work, as LaSeante was saying, but yeah, there would be some overlap, I would say.
So let's say that I'm a person who goes the complete opposite direction. And instead of saying, I want to put everything under one policy, I want to have a separate policy for every single thing that I do. What are some of the concerns that you would have from an underwriting perspective if I have 4 different policies for all the different services I'm operating? There may be common ownership. Maybe I own them all, but I have a separate policy for the auto repair. I have a separate policy for the tax preparation. I have a separate policy for, the babysitting services. Maybe I'm doing them all out of my house.
From a workers' comp perspective, it is possible to split out all the policies, right? Like, you can have multiple policies. What you're going to run into is that some carriers will require to write all of them. Because when you start splitting them up, it's considered a split risk. Because if you have common ownership with all of them, a lot of carriers, mine included, will not write split risk. So you can either combine them all in one policy, or we have to write all of them or none of them at all. So that would be a consideration.
Yeah. I would say even too from a cost standpoint too. So you're balancing 3 or 4 different premiums, and then also the lovely fees that we like to get on our sides too. So additionally, I think if the concern is that you don't feel that you have high enough coverage for in each individual risk, then pursue maybe a umbrella or an excess policy that can go over the one policy that you have for all the specific risk. But the umbrella and excess policy will add in additional limits to cover for if you have higher losses amount.
Okay. I think that we, have kind of talked about this in a really theoretical place. What about some real life examples? Do we have any situations that you can think of that you've seen on your desk or you've written where you've seen this actually occur?
It's not perspective. I have an account right now that I'm working on a renewal where it's a motor carrier. So they actually haul freight, but they also have farm operations. And so both are written on the same policy, but it's coded correctly. And we have distinctive roles in regards to what employees are doing what. And we have the payroll for that so that there's no issues at audit time. So because there's common ownership, we can put it on a single policy, all operations, and then we underwrite it. So you ask the right questions. What are they doing on the farm? Who's responsible for what? You find out all the exposures there so that you can properly underwrite it. So it is possible. And then we have another account where they did want to separate the two. So there's a restaurant that they're running, but then there's also a motor carrier function to that as well, because they do deliveries. And so again, it's common ownership, so we have to write both accounts. But it is a separation because one is an LLC and one is a corporation, and that's perfectly fine.
And those are on one policy, not on two separate policies.
So the first example is on a single policy with the motor carrier operations in the farm. The other one is separate.
Okay. We've got a question that came in about the fact that if we're writing them on separate policies, then aren't they really getting additional limits for their business operations?
Well, technically, but it's specific to that business operation, right? So, it's more of a trigger. Like she said, it was a split risk. So, basically, the carrier is going to respond if you have 1 mil, 2 mil, let's say, limits. It'll respond based on that business operation. But again, you're playing multiple premiums across the board. So, it is a way to kind of further protect yourself, but at the same time, you're splitting up. I guess the loss exposures amongst different carriers, which they really don't like, to be honest. It's really just an insurance carrier kind of preference that, hey, if we want to write the risk, we're writing the full risk, because what happens is you may have a loss with the auto repair, but if it's all in the same spot, the insurance carriers who are doing the auto, who are doing the I forgot you were tattooing too, right? What were you doing?
We're doing it all.
Right.
We're hustling.
So the actual trigger response may get everyone involved because it's at one location, or they may not be able to delineate, well, where they come in to see you for the auto repair, or they come to see you for the babysitting, and that can cause problems amongst the insurance carriers.
Okay. And I think this kind of goes to another question where we're talking about properly underwriting risks, right? So we're talking about pressures to have an increase in production, and how that competes with your desire to properly underwrite the risk. So you've got that risk that's doing the 4 different operations, but you need to write. You need premium written, and so how does that influence your desire as an underwriter to really get into understanding the risk that you're writing? Anyone?
Even though this isn't part of my expertise, as an underwriter, it's like, you always want to balance, your underwriting mindset, your underwriting discipline with collecting premium. At the end of the day, we want to write accounts that are going to be sticky, accounts that are going to retain year over year, so we can continuously collect that premium. I'm not necessarily going to make a questionable underwriting decision to chase sales and marketing goals. That's just my philosophy on how I underwrite, how I have my team underwrite. So we want to make sure that we're asking all the right questions. So, not only is if it's a good risk now, both from a customer or premium standpoint, we want to make sure it's a good risk, 5, 10, 15 years from now. We want to make sure that we maintain that brand loyalty with the client so we can continue to collect the premium year over year.
Yeah. I think that's a great segue to one of the other things that we have as we talk about, and Deon, I know we talked about this in some of our prep conversations, that there are some different tools that you as an underwriter are using to look at, is that person really giving you honest information when you are evaluating that? Can you talk through some of those things that you as an underwriter are looking at to make sure that you are properly underwriting that risk?
Well, I think the biggest thing is the relationship. One of the things I talk to my underwriters about is making sure that we build a relationship with the broker so that there's a level of trust, so that we're comfortable with the information that they're submitting to us, but yet it's trust but verify, right? We get the application, we get all the information, and then your underwriting brain kicks in. It's like, okay, how many drivers are there to a certain amount of vehicles on the car? Does it make sense for the vehicles that are being used? And then is the usage on point? Right? Just making sure that the vehicles are being used in the way that we're being described that they're being used, right? We want to make sure that we're able to make those proper decisions based off of the information that we get, because it's all about trust at this point. right? It's like 9 times out of 10, we won't know if anything is off until there's a claim. But when there's a claim, that might be too late, and the profitability of that account could be wrecked. So there's a lot of front end underwriting that needs to be done. Both from the agent and the broker, and from the underwriters themselves.
Yeah, that relationship is a really huge point, particularly when you're talking with the position of trusting the agent or the broker that's submitting the risk to you, right? Building that relationship so that you know that that person is bringing you quality business. What do you do if you have a concern about that?
Mhm. Just continue to pry, right? I mean, being an underwriter, you're naturally curious, right? If something doesn't feel right, then you craft a question based on that feel, right? It's like, I don't, I'm not gonna put my name on a risk if I have any level of doubt or any questions on it. I want to make sure that all my questions are correct. So for my end, I'm putting putting the right risk on our books, but also protecting the broker, making sure that they have a client that they can have for the long term on their books. So, profitability runs both ways, right?
Yeah.
It's important for the brokers that this account is profitable as well. So it makes sense to make sure that all of my underwriting fears and questions are answered.
Yeah. I think one of the things that you brought up was eh, an underwriter will probe you, and it's not because we're being mean. We need to basically verify this risk. It's that trust but verify. We're verifying that what you said is accurate. And as much as I know you, I still need to verify, right? LaSeante, what were you going to say about that?
Yeah, I would say, underwriters are both curious and nosy. Okay. So we're gonna dig all into their business, because that's our jobs, right? So if I'm looking at an application, I know Deon started with that in the relationship. If I'm looking at an application and I get something in for, a landscaper, right? And they say that we go out there and we treat grass, but I go and look at their website and they climbing on roofs. What we doing? Right.
Mm,
And so now I'm like, okay, that's different. That's a little something, more than what they're putting on this application. And then I'm going to Facebook and I'm looking at, well, what kind of roofs are we climbing? And they own 3-story roofs. Wait a minute. So then you're reaching out to your broker, your agent, and saying, well, did you know they were doing this? And they're like, absolutely not. And I've come across that a lot where agents, they're not necessarily, misrepresenting anything. They just don't know what they don't know. They're taking their client's word for it, but it's up to us as the underwriter to definitely dig into it a lot further. And so, just some resources that I usually take a look at is, their websites. I look at Google, social media. I'll look at Yelp, depending on the type of business. If it's a restaurant or, a hotel or something like that, I'm looking at Yelp to see what's going on in there. If there's, for a hotel, are there bed bugs usually present, biting on the employees and, health issues or things like that. What kind of exposures are we looking at there? Then, also you have your bureau searches. NCCI is one of my best friends when it comes to, looking up different class codes, different exposures. You have SAFER, you have OSHA and things like that. So you have to dig in. You have to dig in. That's our responsibility as underwriters.
Yeah. And just to add to that too, I know LaSeante's focus, there are some back end verification things too as well that either the carrier or the wholesaler may implement. For instance, they may perform an inspection, a physical inspection at the location, or a phone call to confirm certain payrolls or certain sales amounts. So there is, even when the front end can get through, there is some back end verification during the policy period that certain carriers or certain companies will instill to make sure, hey, like you said, we're trying to verify exactly what you told us.
yeah.
And
And
that's the truth. It's, at least from a high net worth standpoint, for example, when we're reviewing a home, like the application is the trust part.
Right.
Once we bind the business, an inspection is ordered. The
Right.
inspection is the verification. So that's going to tell us everything that you said on the application, whether or not it was accurate or not. The condition of your home, if there's any businesses that are being run within the home, we get all those answers right away. So the trust but verify is real, and I think the companies do a good job in making sure that we verify.
I think we're going to walk away with trust but verify slogan.
I like the curious but nosy too.
Yes,
Pretty
That's
good.
that will get us going.
So I think, Ryan, you brought up something that I think kind of still speaks to that. We've spent a lot of time talking about that front end verification, but then we've got that back end verification in policy auditing, right? That happens in commercial risks. And I know we've talked about the notorious, if any, classification that some people like to put on the policy. Hey, I'm going to put all those class codes, and I'm just going to say, if any, to solve the problem of you asking those nosy questions. I'm going to say if any. Well, what happens at audit time on an if any?
And I know LaSeante can speak to this more so than I can because he's in work comp, and that's something that they usually do. But there also is auditing on my side where I do more general liability stuff. So that's in this circumstance, like you said, if any. Well, maybe I have 500,000 in sales. What they'll do is they'll perform an audit on you. They'll come to your files. They'll look up your, profit and loss statements. They'll get all that information and assess, okay, is it 500,000 or is it 500 million, right? And so depending on that figure, the audit, they'll charge you based on your own files. So they will come in and literally take your files or see your files or request your files. If you deny, that's a whole nother situation where they could probably just NOC you, right? Or just cancel you because they say, well, you're not being transparent with us. So I know LaSeante probably could speak a little bit better to the if any process.
Yeah, so I see that quite often. And so with workers' comp, you have what we call our 3A states and our 3C states. 3A meaning you definitely have exposure in those particular states. 3C meaning there may be some incidental, right? And so what we see is that some companies will put states on a policy and say, well, we may have some exposure there later on in the year. So let's put the class code on there. But since we don't have payroll right now, we'll put it on if any. The issue comes in when you don't report that into your carrier. And so if they are rating your policy based on no payroll being in that state and that class code, once you do add payroll come audit time, you went from having zero or if any to now having 500,000 or a million in that class code. Well, now you owe some money. And so what we find is that a lot of contractors will put them on reporting payroll so that they can report it monthly so that they can avoid that high audit premium on the back end. But when they're not on payroll reporting, that audit runs around. They're like, well, why do I owe you another $50,000? Well, you remember all those if any's you put on the policy? Well, you actually did hire people in there throughout the year. So now you owe us back that money because we covered them or had coverage in place for them that we didn't initially take into consideration when we first wrote the policy. So it's important that there's communication from the insured when they're adding that payroll in to avoid that additional premium in the end.
Mm-hmm.
And as an underwriter, what sort of guidance are you giving to the agent when you see that large premium coming down? Because I know we have the audit, right, which is that policy that happened in the past, but then you have even the current policy and or the renewal that's occurring. What type of things are you saying to that agent or broker to help them counsel their client through that large increase in premium now?
Yeah, so those are, your pre-renewal discussions when you're, talking to your agents about, well, have they changed any operations? Have they added any new employees? Have they added any new locations and things like that? So that's all part of your renewal discussion for the agent to then go back and ask the insured for updated exposures. And so the agent can then see like, oh, well, they now have payroll in, say, California. And so those are conversations like, okay, well, when did they add that? So just so you know, we had that on an if any basis for the current term. So when that audit comes, there may be some additional premium there. So it's all about being proactive with your agents and having those clear, transparent conversations and pre-renewal discussions.
So it sounds like you're asking your agent to be a little nosy too.
Absolutely.
Absolutely.
Probe just a little bit more.
I'd say too, from just a payment standpoint too. Sometimes we try to, alleviate or have them make payment plans or something like that if it seems to be too significant of an increase leading into their renewal. So there may be carriers that are willing to do, a payment plan, 3-month, 12-month, whatever type of assessment that they can, because eventually the insurance company wants their money, right? We want our money for the premium. So it's better to get whatever money we can based on that than let them walk off in collections and stuff like that.
Absolutely. Don't dodge us. That's the
Right.
don't dodge.
LaSeante has a big bat.
I have another follow-up question to that classification piece that came in through the Q&A, and someone's saying, hey, maybe I'm a little bit newer. What sort of resources can I use for finding out what I need to do for a class code? What kind of things would you all suggest to them as underwriters that they want to get it right? Where do they go? What should they be looking at? What should they be doing?
From workers' comp perspective, it's going to be your bureaus, your rating bureaus. So for NCCI, is going to be a big one. They cover most states. You have Pennsylvania that has their own. You have Michigan that has their own. But you go to the rating bureaus, their websites, and you can look up the different class codes that they have listed based on the scope of the operation. So if you're looking for, let's say, a clerical telecommuter versus someone that's clerical NOC. So you're going to go in, you're going to enter that into your search function, and it'll pull up the class codes for you.
From a liability standpoint, they go by, it's called the Insurance Services Office, so ISO. So I would say you want to look up that information on them. And with liability, with commercial liability, sometimes I think you can go from either small to large or large to small. So depending on the classification, I would just say it's usually based on as much information as the insurer can provide. And then as LaSeante said, if there's websites, if there are other things that we can discover or that you utilize, just send that information into your underwriters too. And usually the underwriters will make the best judgment on what rating or class code you fall under. But if you guess or do your best at guessing it, usually there's no problem with that.
Now, Deon, let's fold you into
To
this
your premium
discussion
auditors
too.
too.
Oh,
I'm sorry,
okay.
go ahead.
I was going to say to fold Deon in because we've got this situation where maybe I've got a personal lines policy and I'm doing some business stuff. Are you using class codes? What are you using as a way to classify that exposure in a personal lines policy?
Well, I think the best way is just gathering the information from the broker or the agent, because a lot of times we just go off of what they're told us, that what they tell us, right? It's like we know the type of vehicle, we know the age of the driver, we know the type of usage from a mileage standpoint. That all goes into the rating, but then they have to be upfront with us. Like, is this being used as, is it just a miscellaneous vehicle, an extra car or something like that? Is it a commuter vehicle that goes back and forth to work, or is there some business elements, right? So that, like, usually a lot of times if you go back through the history of auto insurance, you look at commuter, you look at salesmen, traveling salesmen and things like that, or business owners that are going from client to client. The hard part now is folding into, the Uber, the DoorDash, things like that, and which really blurs the lines, right, between business and personal.
Airbnb is, yeah.
Exactly. And while there's coverage from those entities, from Airbnb, from Uber, how does that blur the line with, with eligibility? Most off, right? Because in most instances, there's no real endorsement on a personal lines policy that you can add, but in a lot of instances, there are exclusionary language for vehicles that are used as livery. So, while there may be coverage while you're delivering, while you're actually transporting a passenger, is that something that the insurance carrier wants to write? And in a lot of instances, they don't. So, and again, in some instances, we don't find that out until there's a loss. So there could be some consequences if there's a loss, but a lot of times it's just the trust with the broker that we're getting the right information right off top, so that we know it's the same as undisclosed drivers, right? If you have possible youthful operators, we'd like to know about that, but we also like to know if somebody has a side hustle, as they may be delivering or Uber or DoorDash or whatever. That could change the eligibility and the rating of those vehicles.
And those exclusions you're talking about, is that just on the primary policy, or is that also inside of the personal umbrella policy?
There was both.
They're both.
There were usually in a lot of instances on the personal lines excess policy, it's a follow form. So whatever the auto policy says, the excess will follow form as well.
So for those who may not be as tenured as some of you, give us a breakdown of follow form versus excess, because people just throw out the term follow form, and I don't think people always understand what that means. So can you break down what does follow form actually mean?
Thanks for reeling me in on that. On the personal excess policy, basically it follows the primary coverage form. So if you have coverage for your 17-year-old driver on your personal auto policy, he'll be covered under the excess policy if there's a loss, and consequently, like we said, if there's exclusion for livery on the personal auto policy, that exclusion will follow form on the personal excess form. So there'll be no coverage if there's a loss in any circumstance while you're using the vehicle as livery.
Okay.
We have a similar thing on the commercial side as well. It's the excess follow form, the same as how Deon just prescribed it for personal lines. There are some circumstances where with follow form, they may not trigger down to certain sub limits as well. So certain things like sexual abuse and molestation, they may not trigger that. So there may be exclusions within the excess policy for certain coverages that it can't follow, just from an insurer standpoint. Additionally, the difference in between what the excess is, and sometimes they're used interchangeable, excess liability and umbrella liability. With the umbrella, which is rare to see, the umbrella can offer additional coverages. So you can add in certain things that weren't covered under your either personal auto or your commercial liability policy. The umbrella can come in and actually add in some coverages. Usually you don't see that, but you know what I mean? Because, you just want to follow whatever the primary insurance company's doing from an excess standpoint.
Sounds like they should be reading the policy, right? Should they read it to understand what's not included that Deon is telling us and what sublimits may not trigger? We want to read those coverage.
A lot of instances, it's the underwriters will read it, right? It's like we talk about, having brokers having relationships with the clients, underwriters having relationships with the brokers. Underwriters also need to have a relationship with the contract. They need to understand the ins and outs of the contract, where to go to, find out where coverage is or isn't in place. So understanding the contract is first and foremost. I think with a lot of carriers, all underwriting training begins with understanding the contract, knowing the language, knowing the basic ins and outs of a particular policy.
Right. Yeah, I wouldn't say we're as prevalent as lawyers or attorneys, but we do have to understand certain language, certain legalities, and how they respond in the policy term.
Yeah. I think this next question that came up in our Q&A is another good, it's a good segue to that, because it's talking about, hey, we've got underwriters who are doing their job. They're being nosy, as LaSeante said, they're digging in, they're probing, they're trying to understand that risk. And, we're seeing that automation is really coming in to be more prevalent. So how are you all seeing the role of an underwriter balance between some portions of that role are automated and other portions really need to continue to belong with the human? What do you all think about that?
I can speak specific to it. Like I said, I have a lot of industry experience. One that I had was working with an insure tech company. So that was something that popped up a while ago. I'm not sure if they're so prevalent now, just because you need a human aspect to that regard. What people may do sometimes from a front end standpoint is, well, I don't know my classification, so I'm going to do my best and put me under whatever. Um, what we started to find was that, you had cannabis growers who were uh, classifying themselves as nurseries or garden, like garden makers or something like that. So it's kind of like, okay, that it seems like that could fit, but cannabis is a different product, and this is why the carrier has to do that. So you need a human aspect still in the background. I think from an automation standpoint, it does help with some of the more support processes, maybe applications or pulling information from a different source. But ultimately, I think underwriting from a human standpoint is still more prevalent than what automation is going to do.
Yeah, I would definitely strongly agree with that. Automation is great when it comes to uploading applications, issuing policies, binding, um, our actuarial as far as rating and things like that. Um, Having class codes like pre-entered where we
Mhm.
can just kind of drop down and choose one, and that aspect. But underwriters will always be needed to investigate. As Ryan alluded to, someone putting in a cannabis farm as a nursery or gardening, perhaps,
Mhm.
um, it's up to us to go in and do that research. So always, that verification piece will always be needed. Same with, risk control. Risk control is always going to be needed. SIU is always going to be needed. So I think, as far as the human aspect, it's never going to go away.
I think automation is a tool, right? It's like it could help speed the underwriting process along, but it shouldn't necessarily be used as your whole toolbox, right?
Mhm.
That it shouldn't be the overarching thing that makes all the underwriting decisions, because there is some gray, there is some nuance that goes with underwriting. And, there's a lot of experienced underwriters that we have. Like sometimes gut is correct
Mm.
and we have a gut feel about something. The automation can help us kind of confirm what we're already thinking, help us make help either confirm or have us have a different decision on what we want to do. But always viewed automation as a tool. We know how quickly that it's moving along and how prevalent that is becoming in the industry. Like LaSeante said, I think there's always going to be a need for a human element in the underwriting process.
Yeah. Look, I've been excited just listening to you all talk about this conversation, and I'm already looking at time and realizing that we are already running low on time, and I still have more questions. So there's some of these questions in the Q&A that we're not going to get to. But I want to make sure that we kind of let you all, and I'm just going to do kind of a round robin and let everybody kind of give if you could give them one takeaway today, what would it be? Um, let's start with LaSeante. What's your one thing that you would want the attendees to walk away with today?
Investigate, like as an underwriter, it is our job to ask questions. Don't shy away from, you asking questions and they pushing back to tell you, can you just quote subject to? No, we can't quote everything subject to. We need information in order to properly rate and underwrite an account. So don't shy away from asking questions, looking, probing. Again, curious but nosy, right? So that's what I would say. Definitely take away.
Okay, Ryan, what would you say? What's your takeaway for today?
I would say integrity. So it's really being upfront, be honest about certain aspects. You don't need to hide anything because it will be found in the end. You may get away with it for a certain time period, but eventually it catches up in the form of either you have a loss or an audit comes about or an inspection comes about. So I would say it's more about integrity through the industry. And that's it. Yeah, be honest.
All right, Deon, I'm gonna let you finish us off.
For me, it's about relationships. It's this is still a person-to-person business. And in all my years of being in the business, the people that I've seen that's been most successful has been able to cultivate relationships across all the spectrums of the industry. With their agents and brokers, with their claims people, with their risk managers, with their colleagues, right? It's just being able to cultivate those strong relationships so that the trust and verification is very, very seamless, right? Like you don't have to ask 50 million questions. That's in the application, or that's in the initial inquiry that they want to write the business. They're going to give you everything that you need. So, build that relationship, build that rapport with all the folks that are within your operations, and you'll be successful.
Wow. Man, you all came prepared to drop jewels on us today. And I know if I should have been taking notes on the side, I have trust but verify, curious and nosy. And Deon gave me another one, and I can't remember right now, but I'm gonna have to come up with that other one because
The tool in the toolbox.
tools in the toolbox. There you go. These were some gems. These were gems that were dropped by you all.
Thank you for watching this flashback episode of NAAIA. We appreciate your time and hope you found the insights valuable. Stay tuned for more enriching content. Until next time, thank you for being a part of the NAAIA community.